Have you ever entered a trade exactly when the momentum dies, or closed your position right before the asset finally breaks out? The Commodity Channel Index, or CCI, is designed to solve this exact problem. It measures current price strength against historical averages to give you a mathematical read on momentum. In this guide, we are going to configure your chart for the CCI and map out two high-probability setups, the trend breakout and the divergence reversal. Open your standard charting platform now. You can apply this to any asset you like, a stock, a Forex pair, or a cryptocurrency. By applying this specific index, we replace the emotional guessing game of when to buy or sell with an objective, rules-based system. Step 1. Open your indicator menu, search for Commodity Channel Index, and add it to your active chart. Now open the CCI settings, find the length or period input, and change it from the default value to exactly 20. Look at the bottom of your screen. You should now see a single line oscillating in a new window directly below your main price chart. This diagram shows the three critical zones on the CCI scale: the plus 100 line at the top, the zero equilibrium line in the middle, and the minus 100 line at the bottom. Watch how the line behaves. When the reading pushes above plus 100, it indicates a strong uptrend. Conversely, a plunge below minus 100 points to a firm downtrend. A common mistake is assuming an extreme high reading, like plus 200, means you should immediately sell. As you can see here, the oscillator stays pinned high because the momentum is sustained and the price keeps climbing. This map provides a clear, quantitative snapshot of your asset's momentum. It strips away the noise of minor price fluctuations, so you can see the actual strength of the move. Using the CCI completely on its own is dangerous. In sideways or choppy markets, the oscillator will frequently trigger false signals, causing you to buy into fakeouts. To fix this, we add a safeguard. Apply a volume indicator to your chart. Your layout should now look exactly like this: price action on top, volume in the middle, and the CCI on the bottom. Now we can look at our first setup, the trend breakout. We use this to target early, long entries. The trigger condition is highly specific. We are pinpointing the exact moment the CCI line moves from below the plus 100 threshold and decisively crosses up through it. Once that crossover happens, check your middle tier. We only validate the entry if the volume indicator confirms rising volume at the exact same time. Requiring both the momentum breakout and the volume confirmation creates a highly constrained, high-probability environment. It ensures you only commit capital when the market proves it has real force behind it. Exiting a trade requires solving the opposite problem. You need to know precisely when an active trend is losing steam before it collapses. This dual chart animation shows the core setup for finding divergence. First, locate a scenario where the asset's price successfully pushes up to form a peak, dips slightly, and then surges to hit a new higher peak. When that higher high happens on the price chart, look straight down at the corresponding CCI line. You are checking to see if the oscillator struggled and failed to surpass its own previous peak. If you draw lines across both sets of peaks, the visual contradiction proves divergence is occurring. The price goes up while the CCI goes down. This structural mismatch is your red flag. It proves that despite the higher price, the momentum driving the asset is dying and a market reversal is imminent. Spotting divergence acts as an early warning radar. It allows you to secure your profits and exit a long position proactively before the market turns against you. Your chart is now configured with a 20-period CCI and a volume filter. You have the tools to spot early breakouts and identify exhausted trends. Keep in mind that no indicator works flawlessly 100% of the time. You have to develop a disciplined eye to filter out bad setups. Let's put this into practice. Pick your favorite asset. Scroll backward in time on the chart and backtest the last 20 trade setups. Actively hunt for those volume-backed breakouts. Draw the conflicting divergence lines yourself to prove the mathematics hold up against historical price action. Consistent trading doesn't come from trying to predict the future. It comes from accurately measuring and acting on undeniable present momentum.